All right, thank you. So hello, everyone, and sorry to hold you back from the summer holidays. So actually, it's not brand new. Let me put it that way. It's a paper that circulated before under a different name. I think it was called Variance Risk Premium across 3 different markets or something like that. So in case you've seen it before, there are some similarities, but I think the direction we've taken is quite different. So co-authors credit. So we have Hitesh, Mathieu, and Sang, who are I think here in the audience. And yeah, so I'm excited to hear what you guys feel about this. So let me give you a bit of backdrop to this. And again, you probably recognize this kind of wording as well, but let me do it anyway. So if you go back to the early option price literature and the credit literature in the 70s, they kind of were spawned from the same research, right? Black-Scholes created both, at least these 2 literatures, probably the real options ones too, but you had option pricing that branched off on one end, and you have credit risk that branched off on the other direction. And to a great extent, these 2 literatures were independent. There are some exceptions that are quite recent. And by the way, I'm not going to be heavy. In fact, I'm not sure I have any references here. That's not me trying to claim credit for everything. That's just me trying to save time. There will be much more exhaustive references in the paper when you get it. But essentially, we've had 2 fairly independent literatures until a bunch of recent papers that I'll talk about later on. But the funny thing is that, or not funny, but an interesting thing is that back in the 70s, in 77 and 79, there were a couple of papers by Bob Geske that kind of suggested that there was no need for these literatures to be independent, in the sense that the idea was that, well, if you want to value stocks and bonds in the Merton model, they become options on the assets of the firm. And then typically option pricing was about valuing options on the stock directly. But in fact, if you wanted to, you could also price derivatives on the stocks and bonds themselves as derivatives or other contingent claims on the fundamental underlying the assets, and simply as compound options on the stocks and bonds. So there was technically, there was no need to kind of break these 2 literatures apart. Now, there's probably good reason why it happened that way anyway. That's a different story. But just the fact remains that the compound models did not really attract much attention, or didn't get much traction for the first, for the last 5 decades or so. So I believe, I know I'm a credit guy, so I know the credit literature, and I can wager that a large part of that is because the credit literature itself was having trouble for many decades in trying to sort of do the basic stuff of linking equity prices, balance sheets, and corporate bond prices or credit spreads. So that probably explains part of it, and I'm sure there's an analogous kind of going on in the options literature. But I think both literatures, at least I can speak for the credit literature, there's progress has been made, and there's a bunch of papers in recent years that have tried to branch out to beyond just going from equity to credit spreads by looking at equity, credit spreads, and options, using option price information to improve estimates of the underlying dynamics. There's been papers on structured credit, CDOs, and so on. And I've always wanted to, but maybe this is finally the time when we can kind of go back and have a look at compound options empirically, properly. And again, I'm not claiming this is the first compound option pricing empirical paper. There's a few papers, including work by Bob Geske himself recently. But let's just say this is one of the early attempts to reignite this literature. So, and this is my view of things, and I know that people have, some colleagues have spoken to see things a little bit differently, but the way I see it, there's one fundamental difference in the way that the 2 literatures have done empirical testing. On the one hand, in the option pricing, with the exception of, and I'm sure you can criticize me for the statement, but I'm going to throw it out there anyway, with the exception of the very early papers in the 70s, most of the estimations have been done, most of the work has been focused on joint estimation of derivatives prices together with the underlying to learn something about the distributions and risk premium. Very seldom has there been work, again, with the exception of the early Black-Scholes papers, on taking the Black-Scholes model or taking an option pricing model, plugging in the parameters and coming up with an option price and seeing if it works, right? Whereas, and it's kind of interesting, I mean, there's all sorts of reasons why this is the case, and I'm not criticizing that, but for historical reasons, I guess, the structural credit model literature, so anything that comes beyond Merton, since Merton, it's been very different. It's been take your model, fit it to, let's say, equity, and then see what the bond price is. And then if the bond price is right or wrong, you draw conclusions from that. There's been very little work until maybe the advent of reduced form models, reduced form credit models that came maybe around the late 90s, early aughties, where people started to do joint estimation, or actually focus on actually using the credit themselves as inputs to the estimation. But we're going to stick with the classic view, the common traditional sort of way of doing things. And essentially what we're going to be doing, one way of pitching what we're going to be doing is to say that we're going to take the credit approach to empirical testing and use it on options and see what happens. I think an anecdotal thing to mention here is maybe that, I don't know, most people I'm guessing in the audience here, people have taught a derivatives course. And I've always felt that, you spend weeks prepping the students to understand the Black-Scholes model, and then you suddenly have a lecture on how to use the Black-Scholes model, and then suddenly there's this great disappointment in the room because it feels like, well, you spent all this time showing us this model, and then when you plug in the volatility, it doesn't work. And then you talk about implied volatilities and so on. And it's kind of what we're trying to do here. Again, I guess that's one way of seeing it. So more specifically, what we're going to try and do is we're going to write down a model. So it's going to be a structural credit model. We're going to use it to say something about equity indices, credit indices, and options on these. Key feature of the model is that we have a common stochastic volatility factor for the underlying assets of the firms. And this factor is priced so that we have a variance risk premium, a common variance risk premium. So that's the model, the theory. There's nothing really new about the theory. Maybe the key thing here is then what we do with it. So on the estimation side, we use as inputs panels of CDX term structure. So we use panels of index CDS spreads from, I think, roughly 2005 to 2019, together with volatility for an equity index, the SP 500 or the SPX vol, simply computed using historical returns on the index. So there's no derivatives price information used in the estimation at all. All we use is credit spreads and physical equity volatility. And then we simply take our model and ask it to give us prices of equity index options and credit spread options, and just see what comes up. That's pretty much the whole exercise. But I guess I have to give you a little bit more detail than that. I won't give you much more, but a little bit more. So our model, again, it's a Merton model. So A here is the assets. So A is the assets of firm J in this case, in the top box. The dynamics of a given firm's assets has a common component. So AM, it has idiosyncratic diffusive risk. So sigma epsilon is the idiosyncratic volatility. And then it has idiosyncratic jumps as well. And then on top of that, the common component has diffusive risk and stochastic volatility. So essentially it's a Heston model for the common asset factor. And what do we do with this? Well, once you have this, you can price most things, right? So for example, just here, just to give you a flavor, if you're familiar with the Leland model, these are the formulas in the Leland paper back from '94. The only thing you really need to do here is to pull out the value of the dollar in default claim, or if you like, this Arrow-Debreu security that pays off 1 whenever the firm defaults, and replace it by the particular format you have in the Leland paper by whatever comes out of our model. Now, if we hadn't had jumps in our model, we would have had a closed form for this. We don't have a closed form because of the jumps. We solve it by simulation, and simulation is improved by having sort of Chebyshev polynomials to approximate functions. And this makes it easier to invert functions, to compute derivatives, and so on and so forth. So again, once we have these dynamics, we have the values of all the debts, we have the values of levered firms, the equities. And again, we can also compute options similarly in these papers. Another key element here, and so this is a messy slide, I should have just reduced it to the bottom pink box, but essentially, if you take the dynamics of equity that comes out of this in our model, if you assume that you have a sufficiently large portfolio, so let's say the SP 500, then the 1/n kicks in, idiosyncratic risk essentially is washed out, and the jump risk is washed out as well, right? And if you find it weird that jump risk washes out, I always had a sort of theory, how can you diversify away defaults? That's not really the way one should think about it. And the way to think about it is that we diversify away the contribution of jumps to the volatility. The jumps are still there, and the jumps are still there in expectation in levels, but they're not there in the second moment when you have a sufficiently large index. Okay, so then we estimate. Estimation is done by maximum likelihood. We assume that we can observe the 5-year CDX spreads perfectly together with the physical volatility of the SP 500. So that's the first blue box on top. And then we have error terms for the observations of the 3, 7, and 10-year tenors for the CDX index. And then we have a bunch of parameters to estimate: the volatility dynamics, the risk premium on diffusive risk, and the variance risk premium, the jump parameters, and idiosyncratic risk. So that's all the detail I'm going to give you on the estimation. Just to say that maybe in the estimation part, we simplify ourselves by having an approximating sort of representative firm that enters into the likelihood. But later, when we actually do option pricing, we do full brute force simulation, so that any sort of relevant sort of diversification kicks in the way it should in pricing. All right, so that's all about the estimation. And then what I want to show you is just to get a sense of how well the model does in the basics, right? So we're asking the model to extract information from CDX spreads and from the physical volatility of the SPX. How well does it do? And the answer is it's pretty good. So first of all, the filtered state variables. So we pull out this aggregate asset value. Don't worry about the levels here. Sorry, the scale. Think that what we really need in our model is the ratio of asset value to boundary. So it's not really informative to have the dollars. The bottom state is the common asset variance, which is the second state variable. Okay. Once we have these, we get a bunch of parameters. Again, this is a whole lot of parameters. I'll just, there's a bunch of assumptions we make. For example, the distress costs are taken exogenously, the tax rates taken exogenously, the recovery on CDS is exogenous, and so on. On the estimation side, maybe I can mention some mean reversion speed is kind of at 2.7, maybe a bit lower than we had for individual firms, or I had in a different paper for individual firms. The correlation between asset value and variance shocks, again, is quite high. And then we have the market price of risk parameters, where the one that's really well identified is the market price of variance risk at -5. And I guess maybe what I should also mention is that we, given that we do the way we do the estimation, we can pull out things like default probabilities and Sharpe ratios. And just to show you that we're not kind of forcing the model to bend over too far, we have an asset Sharpe ratio of just shy of 30%, which I think is okay. Our 10-year cumulative default rate in our model is 1.7%. Remember that the CDX index is an index of investment grade firms. So that should be somewhere between the AAA probability for 10 years, which is 0.5% between 1920 and 2020, and for triple Bs, which is 5%. So at least we're in that bracket. I don't think it's a crazy number. And so we essentially feel like our estimation comes up with fairly reasonable sort of results. Now, what about the pricing of the model? And by the way, just to mention, the estimation here, it's a one-shot estimation for the full sample. Right, we take the whole. It's kind of obvious, but I just want to mention it that we're not doing any rolling windows or any updating in this estimation. Okay, so these are the observables. So panel B here is the 5-year CDX in it, which we fit perfectly. So that's okay. That's comforting to see. For the SP 500 volatility, we also fit it perfectly, except there's a bit of a glitch at the height of the financial crisis. And then when you look at the 3, 7, and 10-year CDXs, you notice actually that we tend to kind of very slightly underestimate 3-year spreads and overestimate 7 and 10-year spreads up to about 2013. And as of 2013, 14, the model is pretty much there. Although, of course, the spreads are much lower. So in relative sense, that's it. But we're quite happy with this so far. So essentially, this is where we extract information. And now, once we have our model and once we have all the parameters, we're essentially just going to ask the model to give us option prices. And we're going to start with equity option prices. Okay, so again, just to clarify, when we say out of sample here, we don't mean in the time series sense, we just mean across market sense. Meaning out of sample means we use information from CDX spreads, physical volatility in the SP 500 to say something about option prices on the index, without using those options in the estimation. This is a figure of average sort of volatility smirks in our model, or skews, if you like, The three panels are 1 month, 1, 3, and 6 months to maturity. The middle are at the money. The left-hand side represents adverse states. So out of the money puts are on the left, out of the money calls are on the right. I'm mentioning that because when we look at the CDX options later, it'll be flipped the other way around. Okay. So I see Björn has a question, but maybe I should take that now. Figure 2, you mean? Yeah, so this is a Garch estimate based on historical returns on the SP 500. Does that answer it, or do you want more details?
No, I was wondering, it's not implied, right? So
no. It's physical. It's only based on the only information we use is prices for the SP 500.
So are you feeding that into the model then, or?
Yeah, that's correct. So that we ask our model to essentially, let me see. One of the constraints in our model is that this equation here, the model implied physical instantaneous volatility, matches the Garch volatility or the historical volatility. And I'll show you a distinction between the physical volatility and the implied volatilities in the later picture, if that's okay.
Okay.
Or do you have something else in mind?
No, I was just wondering, Garch versus spot volatility is a stochastic volatility model with a Heston-like square root process for volatility, or it may not be that.
Yeah.
Yeah. So
you're saying we should have maybe an alternative would have been to use realized intraday volatility or something like that.
I don't know. I don't know what the best way to do it is. It's many ways to do it.
Yeah.
So.
No, we're open to comments on that. But the key thing here is that it's not option-based volatilities we're using as inputs. Okay, where were we? Okay, so whether this is good or bad, of course, is a matter of taste. We think it's pretty good, but maybe to drill down a little bit deeper in this, and maybe this will get a little bit to Björn's question, is if we look at the time series, then later look at volatility premium in this context. So if we look in the time series, the red line here is the model, the blue line is the time series of at the money 1, 3, and 6 month volatilities. And the red line is our model implied option. So if we take our model, we take the parameters of the model once fitted to SPX physical volatility and CDX options, and then we do sort of full-fledged Monte Carlo simulation of all firms in the index to compute options on the SP 500 index value. Those option prices are then translated into implied volatilities, and those implied volatilities are here plotted for 1, 3, and 6 month expirations. Okay, so when we look at this, we were quite happy when we saw this. There seems to be no obvious bias. One thing you might suspect here is that, so by the way, the correlations here, the time series correlations, I think, maybe Sam, correct me if I'm wrong, but they're somewhere in the low to mid 80s for these time series. So the correlation is pretty high. But you might say, well, you know what, you're fitting your model to the SP 500 physical volatility, which is highly correlated to the VIX index. So what do you expect, right? That seems like a reasonable criticism, which is fair enough. So what we've done is to actually plot the volatility premium, so difference between our implied volatilities and the physical volatility, data and model. And you're right, whoever thought of that question would be right in the context of the 1 month maturity. On the 1 month maturity, the data is much more variable, the blue line, than the model, the red line. There's a correlation of 0.55, but this may not be that satisfying. But then when you go to 3 and 6 month options, the time series variation is tracked much, much better. So although it's not perfect, I would say that our model does not give us a reasonable time series fit for the volatilities just because it fits the physical volatility right. It's actually predicting fairly well, or better than we at least expected, the time series variation of the wedge between physical and risk-adjusted volatilities. Okay, so we get an 80% correlation for 6 months, 70 at 3 months, and a bit lower at 1 month. Okay, Michael, I'll take your question later on, maybe. Okay, so That's it. That's it for SP 500 options. So now we're going to move on to credit spread options. Thankfully, I don't have to do a big job sort of introducing these. These were introduced in a previous talk by Anders Tolle. So I think all you kind of really have to know for the purpose of getting our results here is that there are options on an index of credit default swap spreads, the CDX index. Now, these options are quoted in ways that are slightly different, but intuitively, you can just think of them as calls and puts on the level of credit spreads for an index. And so we're going to do the same thing here. So we're going to take our model, and we're not going to change anything relative to the output we had in the previous 3-4 slides. But instead, we're just going to take our model, same parameters, same fit, same everything, and say, okay, now please give us prices for swaptions, meaning options on credit default swaps, or if you like, just options on credit spreads, and see how it does there. And it doesn't do as well. That's the first thing. But if you look at levels, it's not that bad. We actually get a slight tendency to overestimate implied vols. The red bars is the model, and the blue, again, the blue is the data implied volatility. Note here that the skew is flipped along the vertical axis, so that the adverse states of the world are now on the right-hand side. High credit spreads are on the right, which would be equivalent to low states for the equity index. There's a slight tendency to overestimate the qualitative aspect of the skew, and the term structure is reasonable. And yeah, that's kind of the first snapshot, just to get the overall levels right. Then when we get to the time series, well, the correlation I think here is much lower. Again, sorry, I can't remember the numbers now, but I'm thinking it's between 30 and 50% across maturities, with a higher correlation for longer maturities. It's worse, and the reason it's worse is because our model tends to have a much more volatile implied volatility in the time series. So the average turns out kind of okay, but anyway, this is kind of what happens. So our trouble here is in getting the time series right. So we're thinking about ways to do that, and we're open to ideas for one of the ways to do it. So one thing we might have is things we could introduce in the model is to have a second volatility factor, maybe to have, we may need to go for systematic jumps, maybe for shorter term options and so on. But there's no specific sort of levels bias going on here. And if we look at the other thing, which was that, well, you know, the reason it's worse may not be that surprising, in the sense that when we fitted the, when we estimated the model, we actually fitted the equity index volatility perfectly, right? There's no constraint on the physical volatility of the CDX index in our estimation. That's completely an output. And we can see here that this is something which, you know, it's clearly not nearly as good a fit as for the SP 500. But again, the level, we seem to be capturing the overall level of the physical volatility fairly well. There does not seem to be any particular bias in there. And if we move on to the premium, things get a little bit worse, right? So we are able to get some correlation for our predicted differences between physical and risk neutral volatilities for the longer end. But again, this is not great compared to what we get for equity options. So yeah, in a nutshell, that's kind of it. That's kind of what we have in our paper. And one more thing, maybe just to kind of, so there was a paper, so a paper by Pierre Colin, Anders Tolle, and Benjamin Junge was presented a couple of months ago, I guess, in this forum. And I was wondering, when we saw the differences in our results, their results is they tend to get a bias in the level of the implied volatilities. And I was wondering what that might be about. So we haven't actually gone to the point of really digging into their model, but what we've done in our model is just to see how far stochastic volatility per se brings us. And this is just sort of taking our model. So the red dotted line is our baseline model, the one that you've seen the results for, and then just simulating out a distribution for credit spreads for the horizon of an option. Right. So this is the distributions of, on the top, equity prices, so the SP 500 level, if you like, and the bottom panel is for credit spreads. Again, the distribution faced by an option on these quantities. And you can see that, well, clearly, of course, what we're not seeing in detail here is what the tails look like and all that. But the overall qualitative shape for the equity index is not that dissimilar, whether or not you have stochastic volatility. But there's a fairly big difference when you look at the credit index. The stochastic volatility seems to give us a much wider distribution, which relies, again, so by the way, this is our model, so it's not just, constant variance is not just Black-Scholes. We still have idiosyncratic jumps in the model. But shutting down the stochastic volatility narrows the distribution of the credit spreads quite a bit. And this would essentially reduce the volatility that we would get from our model, the volatility level. And we're wondering if this is maybe an indication of what's at play or the differences between our two papers. And yeah, I think maybe I can move to questions and then summarize after.
Well, yeah, let's take a few of them. There's been a discussion going on. Well, Mike Chernov, as you've seen, has asked or commented that it would be nice to look at option implied skewness on top of option implied variances. And then Nick was asking what was your intuition why the model generates better results for long maturity variance risk premia than for shorter maturities. And these two comments are probably related, as kind of Sang implicitly pointed out. You don't have kind of systematic jumps, right? You want to comment on that, or?
Yeah, so maybe just so to Mike, I can just say, yeah, we should look at that, and I'll just agree with you on that and see if there's anything you have to say relative to my next statement. But so when it comes to variance risk premia on this thing, so the variance risk premia, they don't really do much for short-term equity options. Okay, they don't, in the sense that they're not, in our model, they don't really do much because there's really not much stochastic volatility within that one horizon. You probably need jumps to get a little bit of action there. However, because this is a compound model, the variance risk premia is still important, because if we didn't have them, they would, how should I put it? If we didn't have them, we would be off, we wouldn't be able to fit levels of credit spreads. We would, our whole sort of fundamental structure of the model would kind of break down. So we need the variance risk premia, even though they may not be critical for the relationship between the option and the wedge between the two for short-term options. But then, for example, if you look at long maturity options, well, then that's kind of where the variance risk gets more room to play. And I think that's my intuition for that.
Yeah, if I can,
we have often had the, yes, Sam, go ahead.
If I can add one thing. So the correlation between the data time series and the model time series is about 90%. So it is more about, time series patterns are very similar, but it is more about the size of the fluctuations. And one thing that we know very well from the literature is that if we only have diffusive risks, then and in the short run, the future distributions are very close to log normal. And we know that under a log normal model, VRP is 0, right? So in our model, we do have jumps, but we're considering the equity index, which consists of 500 firms. Because these are all idiosyncratic, if we have a large number of firms, the law of large number kicks in. So at the end of the day, the effect of jumps become deterministic. So it is always a negative drift every period. So because of that, we really do not have any jump risk. And as a result, if we look at very short periods, we only have diffusive shocks. That actually makes a VRP very small. That's why even if asset variance changes, VRP does not really change for the short horizon. But that effect actually becomes bigger as the square root term of the CIR process actually kicks in a slightly longer horizon. So, but we want to emphasize that although the fluctuations are not as big, but their correlations are actually correlations among these 1 month maturity options are over 89% in our results.
Yeah, so I'll paraphrase a question from Steve Fligluski. I hope I'll do it right. So you have variation in the variance risk premia, but it's fully driven by the variation in the underlying variance, right? Is there any way you could relax that assumption?
So first of all, I think before I respond to the second part of that comment, so the risk premia here will be driven by, yeah, you're right. There's a combination between, actually, if you look at the slides, Actually, it doesn't matter. Just the variance risk premium is going to be a function of, the risk premium on a bond or a CDS contract, if that's what we're talking about. If we're talking about, let's say, the part of the credit spread that is due to a risk premium as opposed to expected losses, that's going to depend on a number of things. It's going to depend, you're right, on the level of variance risk premium, which is tied in the way we specified it is a defined function of the level of the common variance. It's also going to depend on the diffusive risk, in the sense that, and I think this is kind of something that took us a long time to think through. Risk premia also depend on levered factors, right? So the relationship between the underlying and a CDS contract, or the relationship between the underlying and a stock or a bond, depend on the time series variation of the model, which is maybe the extension we're talking about, but they also depend on the time series variation in the elasticities, the deltas, the Greeks, and so on. So I wonder how, so I don't have an answer to how well our model would do if we tried to sort of say, look at model predicted credit spread premia versus actuals. And even I'm not even sure how you would compute the actuals in a time series sense. You would need KMV EDFs or something like that, maybe. So I don't know. So that's the first thing. So I don't know how unvariable they are. I think they probably are quite variable over time. So when you have, and sorry, actually, and maybe another way to express this is that in a previous paper where I essentially show that you need variance risk to match levels of credit spreads, the reason that the variance risk premium allows you to do that is not because it's variance risk per se. What you really need is a risk premium that is countercyclical or cyclical. I never remember which way is which, but that moves over the cycle. And if you think of the volatility, the common volatility as proxying for the cycle, then we do have countercyclical volatilities. Sorry, risk premium, and then that is what helps us fit the credit spreads. So, but I don't know. Yeah. So go ahead if that's something I missed.
I'm sorry. I would like to maybe expand and clarify a little bit what my question was. Mm-hmm. It seems to me that you've done very elaborate modeling of the physical process, but basically assuming the risk neutralization process is quite stationary. So constant price of volatility, variance risk premium and so forth. Whereas the kind of things what you're seeing is you don't get as much variability you get too much variability in the real world relative to your model. Yeah. And also, if you look in what you see in the Wall Street Journal or among practitioners, this idea of risk on, risk off as being a feature of the markets today, that says very much that the attitude about bearing risk changes tremendously from one period to another and very sharply. Yeah. So that's what I'm thinking is missing in the model.
Okay. Maybe you're absolutely right. I mean, we have a very simple way of specifying the variance risk premium. The diffusive risk premium is constant completely. The variance risk premium at the unlevered asset level is defined in the volatility or the variance. And maybe we could do no more. So when you think about relaxing that, what is the metric you think we should be targeting? Are you thinking about volatility premium? Are you thinking about credit spread premium? Or are you thinking about
all of them? All of them, but certainly the ones that change fastest, and I would think maybe credit risk premium would be subject to sharp changes, but we see it in other things too.
Yeah, so maybe we can look at credit risk premium.
Yeah, can I add one?
Sure, go ahead. Sam.
So to be very clear, our model's credit risk premium is not constant because credit risk premium varies over time because the asset variance actually changes over time, so it is a function of that. Also, the firm's asset value changes, and that changes the leverage, and that leverage effect actually changes the credit spread. So it is actually the case where credit spread and credit risk premium is actually changing a lot in our model. But the real question here we're looking at is whether such changes in the data are really consistent with what the equity market and the level of credit spread imply. And we have, go ahead. Yeah.
But it may well be, right, that the reason we're doing less well in the time series of implied volatilities for CDX is because we're not getting the credit risk premium down right. Right? And that may very well be what Stephen had in
So
mind.
I think it is again a little bit of an integration story, although our paper really does not really have a big significant gap between model CDX swaption prices and the data CDX swaption prices. So if we see our time series of implied volatilities for CDX options, usually the problem that we have are some. I think there are 6 peaks that actually makes our fit really, really bad. Other than these 6 peaks, our model fit is pretty good. And these 6 peaks are all happening when there was a fast stock market declines with sharp volatility spikes. For example, we had a pretty bad stock market drop early 2018. At the time, stock market volatility spiked up, and the stock value actually decreased sharply. At the time, we're worried about like inflation, deflation risk and everything. But credit market did not move very much at the time, although the equity market actually was heavily impacted. So such events are the problems of our model, because our model predicts that during such events, equity markets dropped and equity volatility spiked up. So credit implied volatility should also go up, but that did not happen in the data. So more about some extra credit specific factors that we might need to incorporate to generate a better fit. But it is true that the level of CDX swaptions, except for these extreme events, are pretty consistent with the data level.
Okay.
Had I guess a question
Yep.
about fitting. So if you threw me some data on CDS spreads and physical S&P vol, and say in your credits class, and asked me, oh, what can I say about option prices just from this data, and I had like less than a week to do it, I probably would have thrown together what I learned in your class with what I learned in Christian's class and say, oh, well, with options, I can do a fit on the implied vol surface. So here on the long end with the CDS, I'll take something like a Leland model to get the vol. And then when the maturity is 0, I'll just take the physical vol. So now I have the long end, I have the short end, and I try to fit some kind of implied vol surface. And just from that, I'll look at what kind of option prices I'm getting on the much shorter end of it, right? The CDS goes out to 5 years, but on the options, I'm looking at under 6 months. But then what I think you will have on top of that is now you're actually taking into account the correct shape of the payoffs, that it's not, options are not quite like bonds to the underlying. It's actually a compound option. So you can't just try to say apply Merton everywhere, because then you're not really comparing apples to apples. And so there are like kind of 2 steps to this fit, and really like to find out how much bite you get from each. We just try to proxy sort of guess at what's the implied vol at the far end, and try to fit a surface to get the option prices. And then there's the additional gain you get from actually specifying the structure of everything and modeling the payoffs properly. And then that should probably lead to some improvement as well. And we'll be curious to find out how much bite you're getting out of just the naive fitting versus the additional gain you might get from imposing the proper structure restriction.
So can you clarify what you mean by naive fitting? Which part is that?
Naive? Literally just you can I guess do it 2 ways. You can say, okay, I have options. I want to know the bond prices. So from the options, I spline through implied vol surface, right? And then I push that out to a maturity of 5 years. It's probably going to be horrible, but that's going to give me an implied vol that I can shove into Leland. So you wouldn't be taking Leland literally, because if you take it literally, then the implied vol should be the same as the physical vol, right? But just sort of taking this.
But you also need to delever it, right? So
yeah, so you have.
So your point is how much is that delevering structure worth?
Well, so
there's
the delevering, and then there's the gap that it gives you between the physical vol and the, because you can start with the physical vol and delever it and plug it into Leland, but that gives you the credit spread puzzle, right? But if instead of starting with the physical vol, if you take an implied vol that's generated by this fit option vol surface, maybe it still gives you a credit spread proposal after delevering, but maybe not as much. Or you can, as you say, go the other way around. You can start with the credit spreads, get the implied vol from that, lever it into the into the asset, into the stock, and then on the short end you just impose, well, at zero maturity, I'll just impose the physical, spline through, and see what kind of option you can essentially move either way. But really, to me, there are two things. There's the gain you get from just moving from physical to some kind of Leland implied vol that will help you relieve part of it. And then the second step is, okay, what if we impose a proper structure? We take into account that you have the asset and stock is option on the asset. The options are options on the asset. Once you take into all that stuff into account, how much more do you get? Just to get like a sense of proportion in terms of how much bite you're getting out of each part of it.
Yeah. So I don't know clearly, but one thing I can say is that if you just were to look at a naive version of our model, which is just like essentially Merton, if we not quite Merton, but like, simplify everything down to a one-factor asset dynamics, the things we would lose would be in terms of term structures, implied volatility skews, and things like that. Even if you fitted the model to get spreads right, which when you do that, you get all the P moments wrong. I don't know if I can answer much more detail than that, other than that it's worth thinking about.
I have a question. You had said that the mismatch at the shortest end in the equity options was partly due to the fact that you're not using jumps on the market as a whole, and you gave a pretty good reason why you're not doing that. But I was wondering, to what extent are you correlating the jumps in the idiosyncratic movements? And would that possibly allow you to get a better match? I'm afraid it's going to make the credit default swaps even worse, but
yeah. So you're saying have the idiosyncratic jumps have become
right, kind of a domino effect kind of justification, that if one company is in stress, then it's likely a situation where other
so there's a hybrid between idiosyncratic and common jumps, essentially, some sort of almost like self-exciting jumps.
Well, as a replacement for common jumps, since you said that you
Oh, okay, I see. Yeah, that might be an interesting way of doing it. I have no idea what would happen. I'm not gonna speculate, but I'll take it as a suggestion.
Oh, no, I wasn't expecting. I was just I didn't know if that'd be an interesting direction to go with it.
Yeah, sure. Okay, thank you. Appreciate it.
Actually, along the same line, you don't necessarily have to have jumps that are correlated. You could have factors or a factor that kind of has an impact on the intensity of those jumps.
Yeah.
And then these jumps remain idiosyncratic, but there's kind of a systematic nature in kind of the dynamics of their
the extreme nature of the jumps that are being experienced. Yeah, that would be another method. Yeah.
Okay. How are we doing on the rest of the questions?
I think Sang has been very good at getting back to everyone on a quick notice.
Okay.
Do we still have questions from the audience?
Can I ask one question, guys? So
sure.
You try to save time on skipping on the literature. So it's not like
yes.
I'm asking you to write a ton of papers, but I just wanted to understand what's the sort of marginal contribution, right? What is the outstanding problem that your paper is solving? I'm particularly under Stroles here. He has a paper with Pierre and Benjamin where they're looking also at CDX options.
Sure.
And SPX options. They had a clear problem, but it seems like you have a sort of a different result, right? Their problem was that they're basically missing the level, right? What kind of surprising result that they're kind of only mispricing in terms of levels, but even time series kind of options were kind of lining up. And you seem to have, if I understand correctly, you have like occasional spikes, which suggest that yes, maybe you're missing static jumps or something. So if you could just elaborate on that, would be great.
Yeah, so there's two. Well, there's part of that question is specifically with respect to that paper. so the difference between the models is that they rely on common jumps, idiosyncratic jumps, and constant vol diffusive dynamics. And to be honest, it's not like, I think this just kind of happened coincidentally. And in our model, we happen to be working with stochastic variance because that's where I came from with the previous paper. Relative to that paper, the contribution is that, yeah, so we kind of, I guess we, in some sense, substitute a level problem for a time series problem. If that's what you're asking in that respect. More generally speaking, the paper, I'm personally, so one thing I find kind of exciting here is that we actually have a model where you can plug in numbers and get option prices, as opposed to, as opposed to taking, so if you take Black-Scholes, okay, and we're not saying we know what to put into Black-Scholes to get option prices, but we have a model that you can actually use to predict levels of option prices, equity option prices, and do fairly well. And I actually think that's a contribution which is, we have different opinions in the team as to how big a deal that is, but from my perspective, I feel that's fairly important. The CDX options to me are like a second test of that sort of contribution, but so if your question is, do we value the CDX contributions more than the SPX contributions? Not necessarily. And specifically to the question about the SPX, I think it's essentially stochastic volatility versus jumps. And it seems like one intuition could be that if you have jumps with constant intensities, like I believe they have in their paper, you don't get enough kind of time variation in the absence of jumps. So you get a lower volatility. You still fit things because you have long tails, but the actual distribution kind of gets narrower, and that may cause trouble in getting volatility levels right. I'm not sure. That's a guess, an unqualified guess. Okay. I don't know if that gets at your question. But...
Well, I'm not sure either, but it's nice to have some detail. Yeah, thanks.
Yeah, sure.
Wow.